Welcome back. It is Wednesday, and y'all know what that means. It is time for us to dive into another live underwriting of an investment that we think is worth buying. Tonight's investment is actually a pretty interesting opportunity. Honestly, if we don't have a client take this deal, we might just take it for ourselves and roll with it because it's a very unique opportunity. So, Andy, I'm gonna go ahead and turn it over to you, man. What are we looking at?
Yeah, Tyler, kind of exactly as you said. And if you wouldn't mind sharing my screen here, what we're looking at today is a Walmart in Chattanooga. And actually, this is a dark Walmart. And what a dark building is essentially sometimes you guys might see where a building is kind of just sitting there and you're wondering, why is no one doing anything with it? And it used to maybe be a Rite Aid, right? This happened a lot with Rite Aid because Rite Aid was recently just bought by Walgreens. Or what this property specifically is Walmart, where you have a corporation that is guaranteeing a lease. They decide to close down the store for whatever reason. They got acquired. The store's not performing well. They still have to pay the landlord the rent. Doesn't matter that the store is closed because the corporation guaranteed the lease. It's a corporate guarantee. So, as always, we like to look at comparables between different properties. In this one, we want to look at what is the cap rate of a typical Walmart. Okay, so if you look at a typical Walmart and their credit rating AA, man, that's about as good as you're going to get for a corporation, right? AA credit rating, you know they're not going anywhere. One of the biggest companies in America, one of the largest employers. How they treat their workers is another story, but they are very profitable, right? So in terms of cap rates, you can see here the typical Walmart term, and depending on how long the term is, the typical cap rates is somewhere 5.5, between 5.5 to up to 6.75 on a 5-year term, right? And typically they have 20-year terms for flat initial term, average rent of about $925,000, and average sale price of $15 million. So this is why we're so interested in looking at this property that we're going to be underwriting for you today, is because it's going to be a lot better than that, right? You want to buy properties at a higher cap rate, right? The higher the cap rate is, the lower the cost. The higher the cap rate, the lower the cost, right? Because you're getting more return on your money, right? So that's what we want to see here. And this cap rate compared to other Walmarts, because it is a dark Walmart, has a higher cap rate, so that gives you potentially a much better deal than other people. So what we're going to put in here for your average investor's annual income, this is a more expensive property. I'm going to put in $250,000. This is probably going to be what the average investor who might want to invest in this deal. This is all to touch towards what your tax benefits are due to cost segregation and depreciation, all that kind of stuff. The more money you make, the more important it is to save in taxes because you save on a higher tax bracket, right? The purchase price as listed is $9.5 million. 9500000, right? The entry cap rate for this one for a 10-year term. So the lease expires in 2031. It's 2021 this year, believe it or not, 2021. It is 7.1% is the cap rate. So if we go back here and we look at what's a 10-year term typically at, 5.7%. So you're getting a 1.4% cap rate premium because the term is so much because it is dark, even compared to the same term, right? And that doesn't really matter to you though. You're still collecting the money.
That's right. So there is inherently a little more risk, obviously, with a dark tenant, right? Because they've closed their doors, they're not operating. But it is still a Walmart. It is still a high credit tenant. Hey, Andy, your screen switched.
Oh, my bad.
It is still a high credit tenant, and they are still paying rent, and they still have lease obligations. So, of course, as with every triple net investment, it is very important to review the leases and make sure you understand exactly what you're buying.
Exactly. So on our 7.1% entry cap rate, and then we're using that. Obviously, you can back out to what the NOI is, right? What is the net operating income? 9.5 million times this 7.1% average cap rate here, $670,000. Now, if we want to compare this to obviously the sheet here, you might see, hey, average rent is $900,000 and average sale price is 15 million. This is technically a neighborhood Walmart. The building is a little bit smaller, but it has a gas station on site. So there's some trade-offs there. That's why the property might be a little bit, less expensive, and also the rent is lower. So that's not something I would necessarily look at. It's still backed by, the same big company, of course, being old Walmart. So we put in here a couple percentage points for due diligence and closing costs, transaction fee, loan to value. What we're looking at on this property is potentially a 75% loan to value, 3.75% interest rate over a 25-year amortization, 1% lender fees is pretty standard for a triple net property like this. In fact, there are some complications, as Tyler said, where it becomes a little bit more risky because they are technically a dark tenant. But look, you're getting paid for the next 10 years, whether or not they're there or not, right? You get paid until 2031. So with as far as a lender goes, a lender should probably have no problem extending your 10-year lease, a 10-year note, right, on these terms, or potentially even better because you have such a strong corporate backer, right? The operating capital here, again, this is calculating just essentially 1 month's interest payment here, or 1 month's mortgage payment. We can multiply it by 2 if we want it to be more. Whole duration of 10 years, right? Selling costs 7%. If you're buying it with a company like us, there might be an asset management fee, or you might be paying a property manager to make sure that all the money's being collected, the property's not going down. Because as we talked about before, Tyler, is that even on a triple net deal, which this is, where Walmart is paying for the insurance and the maintenance and the taxes and everything, there are still some complications that, depending on your level of comfort in dealing with tenants and dealing with owning property, you can choose to hire out outside services to make sure that everything is being collected, that the reimbursements are being paid, they are actually paying the property tax bill, because even if you pay the property tax bill and they're responsible for it, I mean, even if they're supposed to be responsible for the property tax bill, if they don't pay it, you don't want the government coming after you because you're the owner. So there's all those things that go into the management of your asset, and that's why a fee like this is typically prudent to keep in mind, unless you're managing it and you're going to be doing all that work yourself.
Yeah, that's a great point about property taxes. I mean, same with building insurance, right? Like you don't
Mm-hmm.
they're technically supposed to pay for the insurance, but you as the owner want to make sure that you're paying those and then getting reimbursed by the tenants. That way with certainty that it's getting paid. I mean, the last thing you'd want is for the building insurance to lapse, something happens, and then now, yes, maybe your lease does say they have to pay for the insurance or whatever, but you're still going to have to come in there and deal with it and sue them and go through that whole process in order for if anything ever happens to the building. The other thing is too, just because it's a triple net opportunity doesn't mean that it's just pure mailbox money, right? I mean, you still want to make sure that that building is being maintained, that the parking lot is being maintained, because if the tenant leaves or disappears in the middle of the night, you've got to take that property back, and then you'll have to spend the money to make sure that those updates are being made. So it's prudent as a commercial real estate investor to either manage the asset yourself or hire an asset manager.
Exactly. And as we're not trying to dissuade you, obviously, from triple net investments, right? They're as close to mailbox money probably as you get, but there is still a level of risk and a level of work that oftentimes people don't take into account when they're looking to buy these properties, right? when
That's
we
exactly
and
right. Hey, Andy, real quick, we've got a question coming in from Nick
sure.
about the dark space. So let's go ahead and knock that out for him. Nick's asking, would you purchase a dark space with the intention of negotiating an early buyout with the existing tenant and then try to backfill, or purchase the space to collect guaranteed rent on a dark space? Uh, that's that's a great question, Nick. I think that you could really go either way with it, depending on if I mean all you have to do is run a time value of money, was it present value of money, um,
Hmm.
calculation in order to determine what kind of buyout at what discount rate you'd be willing to take. Especially, I mean, I would if I was going to consider something like that, I would go try and find another tenant first, and then have them sign a lease contingent upon the space coming available. That way, I don't ask these guys for a buyout and then have to deal with vacancy. Because I mean, the nice thing is like it's dark, it's guaranteed for 10 years. I'm more likely to just do no work at all, buy this, let it sit there, and then start worrying about that about a year or two out. But Andy,
Right.
what are your thoughts on that?
Well, that's actually perfect to touch on what we're about to cover in the next topic here is what is your exit strategy? Because that is going to determine really at the end of the day how profitable this deal is, right? It's going to be what are you going to do when you sell? And we have a lot of different options for this property, right? We've been talking about, if you guys listen to our CREI weekly investor update that comes out on Monday, where we talk about commercial real estate news and what are the latest trends and things that are going on. One of the biggest trends has been a need for neighborhood, actually, in kind of light industrial and warehousing and shipping, and a lot of these old spaces like an old Walmart, a dark Walmart would be a perfect use to convert in some sort of retail distribution center, right? People need that space because and Walmarts are often located on high traffic corridors where there's high population density because Walmart is going to do its due diligence and make sure that they put their store in a good location, right?
Yeah, I
That's
mean
they
they
have
have
a
one of the
whole
most sophisticated real estate departments in the world. I mean, because it
exactly.
makes a big difference. Because I mean they're spending they're making a massive investment anywhere they go. It's not like they can just do a small little store, sign a lease, and they're done.
Exactly, Tyler. And because of that, you know that a Walmart like this is, 99 times out of 100 in a really good location. So, how hard would it be to potentially find another tenant, right? Potentially find another tenant who does that kind of stuff, especially we're talking 10 years from now, guys. And I know it's hard to see the future, but 2021 versus 2031, do you think there's going to be more e-commerce 10 years from now than today? My gut tells me yes, right? And with more e-commerce, they're going to need more distribution sites like that. So the people who are going to need, high traffic, central locations to distribute packages and all that kind of stuff. And you think about a Walmart with tall ceilings, it's the perfect. It virtually is a distribution center as it sits already. So it
That's
would be
a
very, yeah.
that's
Go
a
ahead.
great point, Andy. I mean the thing is like you may be wondering why hasn't Walmart tried to buy out of their lease already? Well, they may have determined that in a few years it'll make more sense to have this as a localized distribution center than it does to have it as an active retail shop. So for now they'll close it down, but in a few years they'll reopen it and activate it that way. We see that every now and then with tenants. Hey Andy, we've got another question from Anatole. Hey guys, thanks a lot for doing this. Was wondering if you were going to review a dark store. Since there is a corporate guarantee, why do finance companies want to stay away from these? I think that's a good question. I think we touched on that just a little bit, but it's because with a dark tenant, there's just inherently more risk that the tenant will disappear. You never know. I mean, Walmart has a lease, right, and it's corporate guaranteed. Could they wake up one day and say, "Hey, we're not going to pay rent anymore. We're done here. Sue us"? I mean, it's possible, and you're probably going to win as the landlord, right? Because you have a document. But I mean, they could fight you, right? And no matter how much of a losing battle it is, they could still fight you. So that's why it's important to check for attorney's fees clauses within these leases, because if there's an attorney's fee clause, then you just hire an attorney and you go after them and sue them because they have to pay it if they lose. That's really about the only thing that I could think of as to why they would inherently make this add it to the risk factor.
Right. And especially too is obviously if they're a dark tenant. So one of the things that we do is that we're trying to always, when we look at a property like this, that the most important thing is reviewing the lease. What are the lease terms? What are the escalation for rent? What kind of outs and ins does the landlord have? Does the tenant have, right? Those are all very important things to assess risk. And some of those things won't be able to quantify, right? If you have a kick out clause that or or a redevelopment clause as a developer, as an owner of the building that says, with 365 days notice, I can kick you out because I'm going to rebuild something on the site, right? Because this is a pretty large amount of acreage and it's actually fairly close to the airport in Chattanooga, the specific property, right? 10 years from now, you might want to rebuild something else. Who knows? If you have a redevelopment clause that allows you to have more flexibility. Now, I'm not saying that this lease does, but those are the things that you're going to want to analyze. For this specific property, one thing to notice is that I believe they have 17 5-year extensions, which is the ability for them to renew a lease for 5 years 17 times, right? So for 35 years. And so if
No,
the kind of the way I
longer than
see it
that.
as
Is it 17? Is it 17 or is it 7 5-year? Because 7 5-year extensions would be 35 years.
oh, I'm sorry, it is 17. Yes, 85 years.
17, yeah, so 85 years. Wow.
Walmart likes to lock it down.
They
So
really do. See, that's how much research they're going to put into these locations because they don't ever want to leave.
so as kind of as Tyler said, I mean, there's really two options here. By the end of the 10 years, either A, Walmart leaves, and if they leave, they're not going to be, it's very, very unlikely that they're going to be paying it to extend the next option, right? And then sit there for another 5 years empty. I very, very highly doubt that. And even if they did do that, you'd still be getting paid. So who cares, right? But if they leave, then you fill it with another retail distribution center, or they come back. They come back nearer to the end of the term. And remember, oh, we're looking at a 7 entry cap rate, but what is a 5-year term for a Walmart actually at? 6 and 7, 6 and 3/4 for a cap rate. So your cap rate actually, if they came back and were actually occupying it, would probably go down, which is good for your value, right? We're assuming 7.5 exit cap rate here. If you either A, sign a new tenant when Walmart leaves at the end of 10 years to another 10 or 15-year lease, this cap rate is probably going to go down because now you have an active tenant who's on a brand new lease. Or B, Walmart comes back, your cap rate also is probably going to go down because now Walmart is in there, and if they've made the recommitment to that store, I find it very hard to believe that they would all of a sudden abandon it again. So kind of either way, this exit cap rate here that we have on annual cap rate growth, probably not even true. You're probably, because this is a dark store, you have actually some ability here, as long as you think that you can find a new tenant for the space to lower that cap rate. So it kind of bridges a little bit with that being able to bring in a new lease, kind of bridges the investment type from a kind of stabilized triple net asset into kind of a value add. You can value add by adding potentially a new tenant or bringing the Walmart back. Either way, it's probably going to increase the value of your property.
Exactly. Exactly. And so just to catch everybody else up on where we are, because there's a number of new viewers that have joined in. So we're assuming in this scenario that you are either joining in on a syndication or you are syndicating this yourself. You'll see here in a second that we have a GP and an LP split. We're going to go through this scenario as an LP GP split, and then we'll come back and do it if you just wanted to buy this on your own, what that would look like.
Exactly, Tyler. And so here's a pretty common LP GP split. It's usually a 6 to 8% preferred return right? Which just means, and on a syndication, just very briefly for those of you who are unfamiliar, typically how it works, there's an active partnership, the general partners, and then there's a limited partners who are the passive partners. Limited partners typically bring the money, general partners usually find the deal and they manage the property, right? So typically, limited partners have what's called a preferred return, where they get paid out first, right? They brought all the money, so their capital needs to be protected first. So usually it's a 6 to 8% preferred return or hurdle. After that 6 to 8%, then the money is distributed between the GP and the LP, just depending on the deal. And this specific one has we have it written up here, and this is fairly common. The GP will then be awarded 20% of the cash flows, and really they have a 20% stake in the property, and the LP has an 80% stake in the property, right? GP gets rewarded. They didn't necessarily bring, they might maybe brought a few percentage points of the money, but the LPs brought the vast majority, but the GPs found the deal and are running the deal so that LPs just collect the money at home. So if we look over here for the IRR for the LP, you're getting a 10% IRR, assuming that the exit cap goes to 7.5, right? If we think that actually this building is actually going to be, let's just say it even sells at a, and before I touch on that, I guess I will also say mention the equity multiple, because IRR is kind of your average rate of return, give or take, yearly. But an easier way to understand it of how good a deal is just looking at the equity multiple. 2.01 means you double your money. So in 10 years, you double your money in this syndication deal if you are an LP, right? But again, that's assuming that Walmart doesn't come back, or or we find a new tenant, which we have elucidated to you guys probably is going to allow you to get a lower cap rate because it's going to be a better lease, or you're going to have Walmart back in there. So let's say what happens if
Go ahead, I was just going to say, to put that 10.24% IRR into perspective, I mean, if you were going to go invest in a value add multifamily project right now, you're probably looking between an 8 and a 12% IRR. So you're kind of right in there. I mean, if you're interested in multifamily, this is going to be a very similar kind of return. Andy, we've got a question real quick. Let's knock this one out from Mike. Why are you showing such a high exit cap rate with such a strong tenant as Walmart? So, Mike, we covered that a few minutes ago, but real quick, so since Walmart is currently dark, we don't know in 10 years if they're going to renew their rental rate or if we are going to bring another tenant in there. So we're assuming a very conservative exit cap rate just to help protect the investment, honestly.
exactly. And I just wanted to, and this is where you play around with it, right? You want to make sure that the conservative estimate is a good deal. Then you can say, hey, I probably think either Walmart will come back or we can bring a new tenant, which will make the deal even better. So potentially I'm looking at an exit cap rate instead of 7. What if it just kind of, instead of 7.5, what if it just stays flat, 7.1? Obviously the building is going to be worth a lot more, and your IRR is going to go up, your equity multiple is going to go up. You're going to get several $100,000 more, if you are able to do that. But you don't want to assume that you will off the start, because Lord knows what can happen in real estate, right? Anything can go wrong. And you don't want to be putting yourself in a situation when you're underwriting a deal where you are assuming the best case scenario, and only in the best case scenario does the deal work for you. Because then when inevitably something goes wrong, because it's the real world and stuff happens, coronavirus will come 10 years from now, COVID 2029, God forbid. And and something weird happens, then you don't want to be stuck with a deal that's all of a sudden going to be super risky, because you have to have the top of the line projections, right? So that's why we want it to be, when we're underwriting, paint a picture that's probably a little more conservative than reality, because you never know what could happen.
Exactly. And at the end of towards the end as well, we'll come back and we'll stress test it. I mean, we'll go through and show you what we would do. I mean, if we were going to buy this deal, we'd say, okay, well, what if the exit cap rate goes up a little bit? What if it goes down a little bit? What if we are able to buy it for less? We'll show you all of that here just in a second.
Yeah, absolutely. And I do want to mention to you guys as well, we're looking at this as a syndication deal currently right now, right? So if we didn't want to look at this as a syndication deal, we could instead look at it as just a straight up purchase. So you go in here. I'm going to switch this GP split to 0. That means I'm not giving any returns to the GP. Obviously, because there is no GP, you just brought all the money yourself. Your IRR is the full 10.24. And this, again, this post-analysis versus this pre-analysis IRR, most people, when you're looking at their deals or you're looking at their investments, are only going to be looking at this number. This is what other people might show you. The reason why we have this is because we have built out all here a bunch of tax return and depreciation schedule analysis based off of doing a cost segregation study that we have always found is going to 99 times out of 100 going to provide you with substantial cash flow benefits, and it's important to realize that. So what we've tried to do, put together here in this model, is a way to show you guys, here's what an estimated amount of these tax benefits could potentially be to your bottom line, because we're trying to paint a little bit more of a realistic picture, because a lot of the reason why people buy real estate in the first place is because of depreciation, is because of tax benefits. So we do find it important to share with you guys that, you need to be thinking about those tax benefits when buying real estate too. So back here, obviously we see that 10.24% IRR. And let's say that you needed, for example, a 15% IRR or 15% kind of return over 10 years, right? Average return. So then you'd have to go in and you'd play with the purchase price, because you're trying to figure out, hey, what is the purchase price I can buy this property at in order to make this number 15, right? And there's a tool in here that we can go and we use something called Solver. It's a really easy tool to use in order to do that. But you don't even need to know how to do all the fancy Excel stuff. You can just see, okay, what if I bought it at $7 million? Right? If I bought this at $7 million, actually, that's not going to exactly affect it, at least the way we set it up here. I realize the reason is because we have this set on a cap rate just to make it easier to understand. We have it set at a cap rate of 7.1%. So when I lower the purchase price here, it's actually going to also lower the income, and so therefore everything's going to end up being just lowered by a certain percentage. So before I do that, let me just say, what is the current rent, right? 674,000 divided 674,500, so equals this divided by 7 million. So this is a way I can use this specific model in order to do that. All right. Let's not do that circular reference. Okay. We're just going to type it by hand. We're going to go manual. 674,500 divided by 7 million. So where you have a 9.64% cap rate instead, I know this income ends up going up, but functionally the numbers would be the same. Just the way we have this model set up to make it easier to understand is this is just we're going to have to do. If your purchase price was 7 million, you'd be getting a 19% IRR, which is obviously really good, but no seller is going to let that happen, So maybe it's an $8 million purchase price. That's closer. Could you get 20% off this building? Maybe not. If you bought it all cash and close tomorrow. Perhaps if you can close in one day, they would give it to you, or something like that. But that's way you want to play around with the purchase price. Obviously, that's the lever you can pull if you need to have a higher percentage return, because in real estate you want to buy low and sell high. And if you think that you can buy it at a better deal, then at the end of the analysis, right, at the end of your holding period, you're actually going to be able to make a lot of money because you bought the property at a discount. So those are the types of things that you want to be going in and figuring out.
That's right, and that's just one of the levers that you can pull. I mean, Andy, if you reset it back to what it was originally, let's say you go to the bank and you get better debt terms. Maybe they'll do a 70% LTV with all the other terms remaining the same because, that's kind of what they're looking at. I mean, that would end up obviously being a lesser return. But what if they came in with an
Mm-hmm.
80%?
You can
So
look at
70% down
70%,
to
it goes to
9.44.
9.4,
And then we'll go to
80%
80%.
gets to 11.
So like that's how we come in and we stress test all these deals so that we know, okay, well, within a standard deviation of how much it could swing left or right, positive or negative, how much will this deal be affected? Like Andy, what does it look like if you get a 3.65% interest rate? See, obviously it gets a little bit better, right? Because you're paying less in debt. What does it look back at a 75% LTV? So it
It was
goes
at
down just a little bit.
10.42. Yeah,
Yeah,
when it was at 75 and 375, it was 10.42. So you get a little bit, but
still worth
you know,
arguing over.
a little bit here and there is significant, right? 0.04% of like $10 million. You're gonna want it.
Yeah, so I mean this opportunity here is one that is, I mean, it's a triple net deal, 10 years with one of the highest credit retailers you could possibly get in an area that has a lot of potential adaptive reuses. At a 10.46 IRR, I mean, this is a deal that we would do all day. So, I mean, I actually just texted one of my investors to see if we should do this, but if we don't sell it to a client, we probably will. I mean, it's in a part of Tennessee that we're big on right now. Tennessee has no state income tax, and there's a lot of money coming into this area. So,
And something that I haven't even mentioned here, because obviously we don't want to be sharing too many details about the property here, is that looking at the acreage of the site and the zoning of the site and what you can do potentially, even if the building is somehow worthless, right? If you're talking about redeveloping in Chattanooga 10 years from now, we're investing in Chattanooga because we kind of have a vision of the future. We think, and being based out of Nashville, we've seen how much can change in 10 years. Nashville 10 years ago, it's a night and day difference from Nashville today. And we believe that, Chattanooga, obviously, while way smaller, is on a similar sort of trajectory. So knowing Chattanooga 10 years from now, and we have several acres, regardless of the building, we have several acres potentially on a pretty good location at favorable zoning. We have exit potential of being able to potentially rebuild or redevelop, not just find a new tenant, right? So there's a lot of extra considerations to go into there as well that, make this one a pretty cool opportunity to look at.
yep, that's exactly right. Well, if you're interested in possibly buying this deal, I mean, it is available. Every Wednesday at 5:30, we're finding and underwriting a triple net investment or some other commercial real estate investment that we think is worth looking at. Live underwriting it here with you guys so that y'all can learn it, but also so that you can buy it if you're interested. Right? I mean, these are opportunities that are actively out there. Our contact information is in the description below. You are always welcome to join us, every Wednesday at 5:30 for another opportunity. And then if you want to get on our Deal of the Week newsletter, so that's what we do these live underwritings for, is the Deal of the Week newsletter that we're going to start sending out. We've got a lot of people on there that are everything from people who just want to invest with other people to individuals that have large 1031 exchanges that are interested in assets like these. So you can go on that newsletter. I want to say it's tylercobble.com/newsletters. Pretty straightforward. Just go to my website and on the About section, there's a newsletters tab, and sign up for the investor list. That's one way to start getting these deals as well. So that's it for this deal today, guys. We do have some more information on it. If you're interested, reach out via email below. Otherwise, we'll see y'all next week.